CARES Act. And it is not the word of CARES. It is actually abbreviation of Coronavirus Aid, Relief, and Economic Security Act. So it is put into law, and it is abbreviated as a CARES Act. It started to be effective on March 27, 2020. And in here, I am going to go through 13 points. 5 related to individual, 8 related to business. So the rest of the time, I will go through each one, and I will do my best to give you the clear understanding, and you can take a note, and you know that you have this webinar recorded on YouTube, so you can always come back to look at it. And if taking notes gonna make you forget listening, then stop taking notes. You have me and on recording, so you can always go back. Okay. So now let's talk about the 5 for individual. So the first one I need to talk about for individual is everything you know is stimulus check, right? So $12,000 per eligible person, $2,400 for couple, and for dependent is $500 per dependent. So I know majority of the folks are already receiving their stimulus check. You got it in your pocket. And we're talking about 2020. So your 2020 tax return and any refund that you will get, and it will still be the same. So this $2,400 or $1,200 really don't have anything to do with what you're going to do with your 2020. So it's not going to reduce anything, but it might increase. Let me tell you why. And let's say there's 2 things I want to clarify. If you make more money in 2020 and didn't qualify stimulus check based on 2020, and you do not need to pay it back if you already got it, okay? Because you're getting your stimulus check based on 2018 and based on 2019 filing record. So maybe 2020 your business boomed, and then you got too much income. You don't need to return that. Okay, you got it. Then what if you didn't qualify for stimulus check because your 2019 you made money, and instead of getting $1,200 you only got a portion, okay? If that's the case, in 2020 when you file your tax return and your income dropped, you qualify for the full amount, you will get the difference. So you will get it, but you won't return. So that's the number one thing related to stimulus check. Now, number 2. Remember we have 5 in individual. This is number 2. Number 2, about your retirement fund. There are 2 things I want to mention to you. It happens at the same time. 2 things. Number 1, no penalty. If you now withdraw retirement funds out, early withdrawal, okay? And as long as it's under $100,000 and you don't have any penalty, remember the penalty was 10%, right? Early withdrawal penalty, remember that? No penalty for 2020. That's one thing happens. The second thing happens is once you withdraw, you know how that will become a 1099-R for you and a taxable? Then you go to your tax preparer, they go, what did you do? Why do you withdraw that? We have to pay 10%. We also have to pay taxes on it, right? Remember that? And for 2020, based on the CARES Act, it says that you're only going to get a 1099-R for 1/3 of the total amount. So let's say you withdrew $100,000. So you don't have the $10,000 penalty, but you also don't pay $100,000 on taxes. You only pay $33,333. Does that make sense? 1/3 of it. So that is what the changes for retirement. And then you're going to say that, well, is that true? Everybody can do that? No. Only eligible people can. But let me tell you who is eligible, right? Look, eligibility, diagnosed with COVID-19. Or your spouse and your dependent is diagnosed with COVID-19. Or due to COVID-19, you are laid off, furloughed, and quarantined, child care is not available, and so on and so forth. So I knew that people who withdraw retirement at this time, they must not be enjoying withdrawing it. They must be going through a hard time and furloughed, laid off, and not enough money, right? And keep in mind, and when you go through these difficulties, you are eligible for taking that advantage. Of course, I didn't really mention to you that right now, because of the stock market, is really not a good time to withdraw any of your investment. Because once you withdraw, you have no chance to go back anymore, right? Your loss becomes permanent. So I knew nobody would want to withdraw retirement just because they want to withdraw. They must be going through hard times right now. Now, there is another thing related to retirement. There's some retirement funds you can borrow out, then you pay it back in 120 days. However, the plan stipulates and you pay it back, you don't pay taxes for the amount you borrow to use, right? Because you paid it back. So now, if you are already having those kind of loan, you can take a breather because you don't have to pay anything back for the year 2020, okay? And so, of course, that started from March when the coronavirus hit all the way to the end of the year. So if you don't pay anything back to 401k because you just don't have it, or you get furloughed, but you normally pay $100 back and you don't even have the $100, that you're not being penalized, and they cannot come back and say, well, that's taxable. So that is a existing loan. You have that privilege. And also know that even if you didn't borrow and you want to borrow, you don't want to take it out, you don't want to do early withdrawal, you just want to borrow it, and that is being expanded, means you can borrow more. And in the past, it's limited to 50% of what you have in the plan. Now, depends on the plan documentation they amended, and those companies, they are doing that right now as we speak, and you can borrow more. So that is number 2 on retirement. I hope that the message so far is clear, right? Now, let's look at this. RMD. What is RMD? RMD is a required minimum distribution. So it only exists on individuals who has 401k, large amount of retirement, but the government says that once you turn 72, and you have to take it out. You have to take it out, because if you don't take it out, it's passed on to, part of your estate. It goes to your kids, and it goes to whoever is beneficiary for the plan. So the government don't want to delay that. They want you to take it out and start paying taxes, right? Now, and a lot of people that in my world are the parents. The parents are probably on RMD for a long time. And, start from 72, so they're probably already in their early 80s. They keep on drawing, $25,000, $35,000 a year because they have to. It came out anyway. With the stock market the way it is, we don't want it to come out. And our parents don't need that money, okay? And they don't need they wish that they don't have to take that money out. If that is the case, you know that, and now you can do it. You don't have to take it out. And if you already taking that out, you can roll it over to IRA, which means roll it over to something, then you don't pay taxes on it. You don't have the taxable income like you normally would have. And especially those ones, you already are on Social Security, and you already have money, and you can't even go shopping anyway for this year. And what do you use money for? I would just leave that in my plan and let the stock market to recover, right? So this is a very useful item for the retired people at age 72 or close to age 72, so they know what's going on, or the one that is already on RMD. So that's number 3. And more for your mom and dad, right? And number 4. And the number 4 is donation. Now, there's a new item come out. It's called a universal deduction for donation. $300 for single and 600 for married jointly, okay? And what that means is, you know how we had this itemized deduction? The deduction was bigger, so donation was kind of doesn't do anything anymore. At 300, it doesn't matter because I got $25,000 in itemized deduction. But this is different. The CARES Act said they will put a line before itemized deduction, which you can take $600 out or $300 as long as you did charitable donation. And universal donation just means that you can donate to any nonprofit. There is no requirement on what kind of nonprofit that is. You can do any. So when you did that, it will be reducing your taxable income. Okay, so that is a new thing in CARES Act. It will come out of 2020 tax return as a new line. All right. So with that understanding, but one more thing I want to clarify, and typically the government always had a high threshold of elimination for donation. So they tell individuals that you can only donate 50% of your total income to nonprofit. So let's say if you make $100,000 a year on your AGI is $100,000, the most you can donate is $50,000. That's what's in the past. But CARES Act says no, you can do 100%. So I can make $100,000 income, I can donate $100,000, and that election is in Schedule A. So you will encounter that in case you did donate all of your money to nonprofit. Okay. And then for the same thing for the company, it used to have a 10% of limitation. Like the company profit, only 10% can be donated. Now they expanded that to 25%. So basically, the spirit of number 4 is you can donate a little more than what you used to. Okay, so that's about number 4 on individual. Let's look at our last item in individual and number 5. Okay, and number 5 pretty much temporarily paused the collection on student loan and the student loan principal, and for most of them is for the federal student loans. So they put a temporary hold on that, so you don't really need to make the payment. So that's number 1. Number 2, they also say that if you are an employer, you can offer benefit to your employee, paying their student loans for them. Every employer can pay for $5,250 per employee. The employer can pay for the employee to their student loan, okay? And it is just a business deduction. You don't have to pay Social Security Medicare on it. And for employee, they don't have to get that $5,250 onto their W-2. So it is a money that employee as if didn't get it, so they don't pay taxes on it. But for employer, you don't need to pay payroll taxes, and you just go ahead, pay that to the student loan. So this allows what I call is a 2 exemption on taxes, income tax exemption and also payroll taxes exemption, right? So that is the number 5, benefiting for individuals. So now we sort of gone through the 5 points for individual. So now we're going to dive into 8 points for a company. Bear with me. So the number 1 business one. So we finished the 5 for the individual, okay? I hope that you take a good note of that. And now we are coming to the 8 of them for business. Number 1, PPP. And of course, it's a big invention in tax, in business, to give that PPP called Paycheck Protection Program. And one thing I want you to take a note, it is still available till the end of June. So folks, And if you are one of those individuals and didn't really apply for PPP, I hope for the next 2 minutes and you change your mind. Let me explain it to you. The PPP comes in as a loan. Initially, it's just underwriting as a loan, but you can apply for forgiveness. And we have seminars here talk about exactly how to do that. And this coming Saturday, I will go through PPP forgiveness application one more time. But I already have at least 2 webinars. I was covering that, and it's still relevant, and you can check on YouTube to learn that, okay? So once you get it forgiven, you are receiving what we call a 1099-C. 1099-C is typically a loan write-off from financial institution. You borrowed money from them, you don't need to pay back, they give you a 1099-C. When you get hold of this form, you would report it, but there is an exemption you can select. So you will not include that in the income. And the expenses you paid related to the PPP money, for example, you paid your payroll, you paid your rent, you paid your utility, those expenses are also not going to be included on your deduction. So you don't want to deduct it twice. So you know that the expenses is not going in, the income is not going in, and you are not paying anything on the PPP amount, the forgiven portion of the amount. You just basically one pocket in, the other pocket out, and you basically spend it, right? The portion that you didn't get forgiven, let's say you just got too much of PPP after you paid what you need to pay, and you just didn't really finish spending it. If that's the case, no problem, and you have 2 years time, 2 years to pay it back, and the interest rate is 1%. So let's say if you borrowed $100,000, okay? So this is one of my example I want to show you because I had actually not one client, few clients, and saying that, well, I don't want to apply for PPP because it's too much trouble, and anyway, I cannot deduct the expenses. If I don't have PPP, I can deduct the expenses. It's the same. And they're saying it's the same. No, it's not the same. Let me explain this to you. Listen to me. Listen to me. If you got a $100,000 PPP loan, okay, let's pretend your tax rate is 25%. We want to make it simple. And if you got forgiven, you don't have to pay this $100,000 back to the bank. And what happened is this $100,000 was paying certain expenses out, right? So you actually got this money to yourself. You covered that piece of expenses, so your overall expense was reduced. And this whole $100,000 you don't pay taxes for. In another case, let's say you got $100,000 PPP, but you didn't get forgiven at all. And this $100,000 PPP is a loan. Okay? And as a loan, and you borrow that money, and so you got expenses you spend $100,000 expenses. So it feels like, well, I don't have the income, but I can deduct the $100,000 expenses. I'm good, right? But the thing is, your expenses that you offset your income, and it's not the same as the $100,000 you get into your pocket. You only saved 25% of that expenses, which is $25,000. So here, let's just read through that. If you are not forgiven, you'll pay $100,000 back to the bank in 2 years, and your expenses related to the $100,000 is deductible from your business. So you pocketed $100,000 times 25%. So because that saves your taxes, right? Your $100,000 saves your taxes, so save 25%. Then you minus your interest expense. So we're talking about the real cash benefit you got was $23,000 versus $100,000. So it is not a apple-to-apple comparison, and the PPP is definitely a money that comes in, even though you don't pay taxes, is as if you received $100,000 income, okay? But on the other scenario, your $100,000 income is not here, and you actually need to pay it back. In fact, you need to pay $2,000 interest on it, right? So the real difference is actually $77,000 cash difference between you have a PPP or you don't have a PPP. And this is number one on business. So CARES Act brought us PPP and how you would plan to benefit from it. So that's number one. Number two, employee retention credit, okay? So there is a qualifier for this, and just, you know, if you have a hard time to understand the retention credit, just remember that it is actually refund of your 941 taxes. Just like that. It's as simple as that. It's a part of the refund of your 941. Refund which part? It refunds the 6.2% of the Social Security match that you have for the employee. But you have to qualify for that. Number one, you did not receive PPP. If you received PPP, you don't qualify for that, for this one, okay? Number two, and you at least partially closed. So like a restaurant, they are at least partially closed because even though now they can work, but they are actually only do, you know, curbside selling, and it's not the like full capacity of open, right? So partially open. You at least partially open, or your sales of this time is less than, a lot less than, 50% less than the time from before. So if these conditions met, you would have a retention credit. And so the period covers on all the 941 taxes you submit from March 27th all the way to December 31st, 2020. So that covers pretty much 4 quarters, right? 4 quarters. Because our first quarter due on April 15, then second quarter due on July 15, then October 15, then January the 15th of 2021. So of the 4 quarters, and you would be able to take that credit. Credit just means that you don't need, the taxes you were going to pay, you don't. You get it back. Get it back on the form 7400. So that's a form that you fill up to do that. But I just want you to know that the qualifier is number one, you didn't get PPP. Number two, and you suffered from coronavirus impact as a business. And I couldn't think of any business that wasn't impacted. So maybe not hospitals and clinics, but so far the business I know, and everybody impacted by coronavirus, negatively impacted. So that's our number two. So number one, we did a PPP. Number two, we did retention credit. Let's work on the 3. Payroll tax deferrals, okay? Payroll tax, obviously when we talk about payroll tax, we're talking about that withholding and the Social Security, Medicare, the thing that we do it on 941, right, related to W-2. The CARES Act permit employer to defer the deposit of the payment for which portion? For employer portion of the Social Security taxes, okay? So they don't have, the employer don't have to really in a hurry to pay for those deposits. They can defer it. This is not the same as a retention credit, because this is saying that you still owe, but you can pay it later. So it's a different way of explaining, giving convenience to the taxpayer, to the employer. I just suddenly had a note saying that. Okay, so I'm looking at the notes just to make sure that I'm still sharing everything okay, because I got a note come up. Looks like you are okay. You just have a lot of questions. I understand. I will go through my business 8 points and time permit, and I will open up for questions. Okay. And so the payroll deferrals is not the same as a credit, as a retention credit. This is just timing delay. You still owe the government, but you don't have interest and penalty. You can delay that. And then here it says that how much can I delay? Then you ask. So CARES Act permit employer, instead of deposit half of these deferred payment by the end of 2021 and the other half on 2022. So that means, let's say I have in year of 2020, and I withheld the employer portion, say 50,000 that I did not deposit, right? What I hold back. And so the law, the CARES Act, allow me to do 25,000 on 2021, the other 25,000 on 2022. Okay, so that's exactly what they're saying about the deferral. So you may say that, well, Ying, does that mean I have to fill up some form? And you do not need to do any deferral election. It is automatically in place, and you can do. That just means that when you file your 941, and you would have a place where to put on your deferral. So the government knows that you are holding on $50,000. It come in later. So you need to do your report properly in order to properly defer on payroll taxes, right? Now, number 4. Net operating loss. This is so good. You have to, if you take home one thing today, I want you to understand this one, okay? So when we do business, and there are times you have a loss in the year. So 2020 might just be the year that you have a big loss, okay? And when Trump did the TCJA tax reform, and not known to a lot of people because nobody really maybe massively need this, so it was not widely public. Nobody knows about this. It's actually take away the right for the businesses to get net operating loss recovered quickly from the gain they had in the past. So now, this CARES Act says you have the CARES Act permit net operating loss from 2018, 19, 20 to be carried back to previous 5 tax years, starting from the earliest. So what exactly that says? That just says that you could, let's say 2020 I had $1 million loss, but in 2019 I actually had a gain. I paid taxes for $500,000. 2018 I had another $500,000 gain. I also paid taxes. Okay, so this law allow me to go back 5 years to get those refund back. So you would file your taxes. And here, we can teach you how to go back, but you can get the taxes you paid in 2019 and 18 back because you had a loss this year. You can go back 5 years. So this is where when we think of the business transaction. So let's say 2020, your business is not doing good. You're so discouraged and you want to close your business. And I would recommend you that maybe you're even thinking, oh yeah, I had someone wanting to buy my business. I'm going to sell that to that person. But before you do all of that, I want you to know you might be just missing out some real cash coming back before you sell it. So don't do that. Don't just close your business without talking to us. And you need to go back to look at 5 years back. Did you pay taxes? If the answer is yes, time to get that money back. All right? So it is a very advantage if you know this NOL rule. Okay? So it says that, for example, a corporation has net operating loss from 2020 can be carried back to offset income from 2015, which may have been in 2015 to 2018. Do you know that those corporations were actually paying a lot more taxes, like 35% or something? So you would get that back. All right? So just keep that in mind, and it is really important for you to understand net operating loss is not lost. And I always tell folks that in business, there really isn't anything, oh, I apologize, didn't really shut down my phone. There really isn't anything about loss. I tell folks that as long as you have the determination to go forward, as long as you're stubborn, you're wooden head, you're just not going to give up, your losses will come back one day. Even if you lose today and tomorrow you make it, you come back to pick it up. And then you get that credit, right? You get that benefit not paying taxes. That's why some businesses, even though they're losing money, they still get people to buy them. They're not buying anything else. They're buying all these losses that in the system that they can use that for tax efficiency doing. Okay, so their people are professional with net operating loss. We literally have, there's in the big firms, in the big CPA firms, you will have people who does nothing but deal with net operating loss. That's how much knowledge is there, how much of a need for a corporation or business to consider that is very important. Okay. Now let's go to. So we talked about net operating loss, right? This is our number 4, and the number 5, limitation on losses. This one is only applies to pass-through entities. So, for example, if I have a partnership and I had more money in my business, in my 1040, I had more money, but my business has a loss. So in the past, there was a limitation. You cannot offset your income, your business loss, with your non-business income. So there is a limit. So this is where the first paragraph says that TCJA. This is the act enacted by Trump when he became a president, and that limited a non-corporate taxpayer from using more than $250,000 of trade and business losses and generated in the year from offsetting non-business income in that year. So which means that if you have a loss coming from a pass-through entity and you made a capital gain of $25,000, say your loss is $25,000 and your gain is $25,000, and they are limiting you just that. You cannot have more than that to offset. Even if your loss is $1 million, you can only do $250,000. Okay, and the CARES Act said, I am reversing that completely. So it's almost like this cloud didn't even exist, because CARES Act came back and put the effective date on 2018. So literally, you can forget about that. It was never really happened, and you can go back to go on CARES Act and make sure that you can completely offset. They take away that eliminations. That's our, well, I did that too fast. That's our number 5. Okay, so now let's go to our number 6. Number 6, if you don't know anything about it, it's just because you haven't really get there yet. But a lot of business, we know, has what we call minimum tax credit, okay, from prior year. So basically, in a very easy way to understand is that they actually paid alternative minimum tax for their prior year taxes. So that can be claimed back. And so here we say that in the past, when you claim that back, you take 4 years to do it. So now the CARES Act says, no, don't worry about that. You can get it back all together at once. So this is where the prior year minimum tax credit, it will become a real cash for you in this year, in 2020 or in 2019. If you didn't file 19 yet, you can get that in 2019 as well, okay? And here I actually laid out the form that you use to report that. And a lot of our folks, when you get to minimum tax credit kind of issue, you absolutely should be our client. You should not be staying out there doing it yourself, and it's not needed. And you are a lot more worth for doing your own business instead of becoming a tax expert. And people hear us talking about minimum tax credit, they pass out. They don't really want to know what's going on, and it's too much to know. But we're the one to make sure that for every cash you have, we get it back for you from IRS. Number 7, for business, okay? This is related to business interest. You know, business borrow money, right? So you have an interest expense. Do you know that your interest expense is actually being limited to 30% of your adjusted taxable income? Always, always. It's always there, okay? So just if you never knew, that is because you never gone over that, so you don't really see it. But now with CARES Act, and it went up to 50%. So that is another change, and the deduction increased for 2019. So folks, and especially if you are in construction business and a huge capital investment, you probably have so much interest expense. And if you don't know number 7, that will be such a big loss. So I want to make sure that you keep in mind there is a number 7, okay, for business interest. Now, my last one for business, 8. Number 8. What is that? And the number 8 is about qualified improvement property. And let me just kind of give you, you're probably going to ask, what is that? What is qualified improvement property? And that is interior improvement made to non-residential real property. Those are known as a qualified improvement property, QIP, okay? And this QIP, and one with the TCJA Act, there was a oversight, and some people call that retail glitches or something, but it is an oversight. So they accidentally classified QIP to be depreciated for 30 years instead of 15 years. Because pushed out to 30 years depreciation, so it lost all the benefit like bonus depreciation, all of that. And so a lot of people since 2018, if they did renovation, they sort of stuck. They didn't really have a way to deduct more. Now, the CARES Act came in, made a correction to it, and put it back into the 15-year category. So now you have the ability to do bonus depreciation. You can change, you can speed up your improvement cost. For example, let's say you had a restaurant, and in 2018, you did $500,000 renovation for the restaurant. And because of TCJA Act, and you were told, oh, well, you have 39 years to depreciate. Sorry if I said 30 years earlier, I meant to say 39. So you had 39 years to depreciate, and, you know, too bad and so sad, and you cannot deduct more. But with this change, with CARES Act change, you actually can make changes to what you didn't do in 2018. Okay? So now, and to do that, you can do it 2 ways. You can do amendment on taxes and to amend that so you can deduct more so you can get your money back, and or you can file form 3115, okay? That's the application for changing accounting method, so you can catch up that way. And this is where the last piece I have for the CARES Act. A lot of people anecdotally tell me that, well, I know I need to do something for my renovation that I did in 2019. Or I heard something about donations. What is that? So now I think you got a total handle of a big picture of what was changing.